let's continue our discussion from the previous episode. The mystery of AI's input-output ratio ultimately boils down to whether the technology itself can achieve the superintelligence level investors expect, thereby bringing about a disruptive leap in productivity. Some experts and technical analysts have raised profound doubts about this, believing that AI faces an insurmountable capacity ceiling. Analyst James Rickards insists that talk of superintelligence is nonsense, and that true superintelligence may never emerge. The core reason is that AI lacks the abductive logic or common sense unique to humans. The law of conservation of information. William A. Dembski mathematically proved the law of conservation of information during search. The most complex AI, even with the fastest processors and large-scale language models, LLMs, cannot discover new information. It can only conduct extremely fast and large-scale searches within existing information. This means that AI lacks the creative ability to compose Beethoven's Ninth Symphony or publish innovative theories like humans. AI is essentially fast, not truly intelligent. A vivid experiment illustrates this capacity ceiling. A supercomputer and a group of first graders were each asked to draw a circle using a ruler, a teapot, and a stove. To computer's failure, the computer knew that a ruler was a drawing tool and attempted to use it to draw a circle, but failed miserably. A children's success. The children glanced at the teapot, realized the bottom was round, and used it to trace a perfect circle. This demonstrates intuitive logic or common sense. At work, a skill that children possess but computers lack. This raises the question. Over $400 billion has been invested in AI infrastructure, but what has that actually bought them? This capacity limitation is reflected in economics as the law of diminishing marginal returns. Despite massive investments in energy and processing power, giants have seen minimal output growth. Disappointing output. Despite investing over $400 billion in infrastructure, profitability remains elusive. New applications like OpenAI's GPT-5 have even been considered major disappointments. Application bottlenecks. A McKinsey report indicates that most companies are still at the co-pilot stage, requiring human guidance, and over 80% have yet to see significant, measurable benefits. A significant gap remains between reality and the expectations of agentic AI. Agentic AI refers to an agent tool that can manage processes autonomously. Therefore, AI's impact on productivity inevitably has a ceiling. Goldman Sachs estimates that AI will not begin to have a measurable impact on U.S. GDP until 2027. Current high valuations of U.S. stocks have likely already overdrawn growth expectations for the next 10 or even 15 years. In other words, investors are betting on a vision that will take 10 to 15 years to realize, and time is the most expensive variable in this gamble. From the above analysis, it can be deduced that the current market has a clear and highly concentrated valuation bubble. This bubble is concentrated in a few AI concept stocks and cannot be offset by actual economic output in the short term. This bubble will eventually burst, and if a black swan event occurs, the chain reaction will be systemic. Current market risks are highly concentrated. Chip giant NVIDIA's price-to-earnings ratio is as high as 56, while data mining company Palantir's is over 500. If market sentiment reverses, these concept stocks out of touch with fundamentals will be among the hardest hit. We don't need to wait for a completely unforeseen event. The recent escalation of the Sino-US trade war over critical minerals is a perfect example of a black swan asterisk risk. Recently, China further tightened its export controls on rare earth elements and critical minerals. These are crucial materials for the manufacture of permanent magnets for electric vehicles, semiconductors, electronics, and AI data centers. China's restrictions directly threaten the supply chain for the new AI infrastructure that the United States has invested heavily in. The United States responded swiftly. Trump issued strong threats to Beijing's actions on social media, calling them surprising and hostile orders. He publicly stated that as President of the United States, he would be forced to take financial countermeasures, once again raising his tariff stick. We can imagine that if this rare earth and critical mineral war escalates further, leading to the withdrawal of funds used for power grid expansion, the supply of copper and rare earth elements used in server chips has been cut off, forcing a slowdown or even halt to $1.1 trillion in power grid investment and hundreds of billions in AI data center construction. This effectively shuts down the new infrastructure engine currently driving U.S. GDP growth. Add to this the news that the AI industry is struggling, such as the failure of applications like OpenAI's GPT-5 to generate the expected returns, and this negative news will directly puncture the valuations of giants that rely on AI stories for their high valuations. This is because a dangerous AI closed-loop economy exists among these AI giants. Asterisk. For example, NVIDIA and OpenAI reached a landmark strategic agreement, planning to invest up to $100 billion in OpenAI in exchange for the use of millions of NVIDIA GPUs in OpenAI's AI infrastructure. Companies like Oracle are also engaging in similar investment for order or cross-shareholding transactions. If OpenAI's profitability story falls apart due to insufficient output, NVIDIA's $100 billion investment commitment and massive demand for GPU orders will collapse instantly. The stock prices of giants like NVIDIA, AMD, and Oracle will suffer a severe blow. Due to the significant weighting of these leading AI companies in U.S. stock indices, their plummeting share prices will trigger mechanical deleveraging among options traders and leveraged ETFs, leading to a deeper and faster sell-off across the market. In the current stock market environment, investors must exercise caution. Some market analysts warn that at the end of a bull market, investors often make the worst decisions, chasing the least profitable and lowest quality companies, attempting to earn the last penny. Those who act recklessly often pay the heaviest price. The market is already highly concentrated, with risks concentrated on the big seven in AI. In this environment, investors should turn their attention to undervalued, reasonably valued anti-bubble assets, such as value stocks, emerging markets, or undervalued sectors. It's only a matter of time before the U.S. stock market enters a bear market. Until AI investments prove their economic value, investors must remain vigilant and manage risk. AI will ultimately bring about technological change, but its economic value has a ceiling, and its realization will take time and be accompanied by a significant capital shakeout. The true test of this technological revolution, AI, has only just begun. The above content is for informational purposes only and does not constitute investment advice. Thank you for your attention.